This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 412 was produced on January 25th, 2024. I'm Eric Townsend. Dr. Anas Alhajji returns for a crude oil market update with a fresh outlook for 2024. Anas says that barring a geopolitical escalation, expect crude prices to hold steady in 2024. But by the late 2020s, Anas says the global energy crisis that I and so many others have predicted will be upon us, and prices will be driven much higher.
And I'm Patrick Serezna with the Macro Scoreboard week over week. As of the close of Wednesday, January 24th, 2024, the S&P 500 March futures were up 266 basis points, trading at 48.98. A strong bullish impulse now pressing towards the 5,000 level. We'll take a closer look at that chart and the key technical levels to watch in our postgame segment. The US dollar index down 12 basis points to 103.25. The March WTI crude oil contract up 349 basis points, trading at 75.09, trying to break out of the 4-month bearish decline. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The March RBOB gasoline up 370 basis points to 224. The February gold contract up 50 basis points to 2016. Copper up 429 basis points to 389. A bullish breakout after positive news from China. The uranium down 175 basis points, trading at 103.90. Uranium is stalling out after its huge advance last week. The U.S. 10-year Treasury yield up 8 basis points, closing at 418. And the key news to watch this week is the PCE price index. And next week we have a number of Mag 7 earnings, the FOMC meeting, the ISM manufacturing PMI, and the U.S. jobs numbers. Now, this week's feature interview guest is Dr. Anas Alhajji. Now, Eric, why did we invite Anas back on the show this week?
Patrick, Anas has made some excellent calls in the last couple of years. His outlook on the market and his predictions have been as good as anyone's. He was also just recently nominated or named the third most influential voice in energy markets of anyone. So very, very significant honor to be awarded that title. And it's perfect timing to get an update. This market is starting to firm up. We're seeing time spreads, particularly at the front of the WTI curve, switching back into backwardation, suggesting that this market is getting a little bit tighter. So it seemed like a perfect time for an update.
Well, Eric's interview with Dr. Anas Alhajji is coming up as Macro Voices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Dr. Anas Alhajji, Managing Partner of Energy Outlook Advisors, former Chief Economist for Natural Gas Partners, and now recently named the number 3 most influential social media influencer on the topic of oil and energy markets, outstripping Dan Yergin and a number of other notable people considerably. So congratulations on the new title, sir.
Thank you. I don't know whether this is true or not, but thank you.
Well, I don't know how they came up with it, but I was certainly proud for you the day that I saw that. And hey, we discovered you on MacroVoices. So everybody just remember where you found the good doctor from. Well, it's great to have you back on MacroVoices. I want to dive right in because the world has changed considerably since the last time that we talked. You just did an excellent Spaces last week. Our listeners got that in last week's Research Roundup email. So if you haven't listened to that, folks, be sure to. Why don't we start with a quick update on what's going on with the Yemen war and how it has changed the face of the oil market, and then tie that in to what you told us last year as we were coming to the end of 2023. How does the forecast look into 2024 now with everything that's changed in the world?
First, we have to make an introduction because this introduction is important to understand what's going on in the Red Sea. Since the Russian invasion of Ukraine, the hottest area in the world became the Red Sea. Literally, the Red Sea became the hottest area. Think about it this way. All of a sudden, now Europe is not importing Russian oil, and Russian oil has to go to Asia, and it has to go through the Suez Canal, Red Sea, and Bab el-Mandeb, which is the strait on the other side of the Suez Canal. So Russian ships, or the Russian oil that's going through the Red Sea, jumped from an average of about 250,000 barrels a day to 1.7 million barrels a day. So you have many tankers passing the Red Sea than before. But at the same time, now Europe does not have enough oil. So the Gulf states, that Saudi Arabia and UAE, Iraq and Kuwait, etc., now they need to send oil to Europe instead of Russia. So we have more oil going north than before. So all of a sudden now we have more tankers going after the invasion of Ukraine than ever, and a very large number of tankers. At the same time, Europe now is short on gas, so Qatar has to send LNG tankers to Europe. So we have more traffic. At the same time, we have this massive growth in US LNG, and that LNG will go to Asia. It was going through the Suez Canal, the Red Sea, going to Asia, especially after the problems with the Panama Canal because of the drought. So we have more ships, more oil, more gas from the United States going through the Red Sea. At the same time, we have the normal traffic going through the Red Sea. So all of a sudden, this area became the hottest. Add to it other facts. Now we are talking about this green economy and what that green economy needs. We have the massive increase in the production of electric vehicles in China, and China needs all those minerals for those batteries and for the cars, and some of them have to come from West Africa and around the globe, especially from Latin America in some cases, and some of that has to go through the Red Sea. Now China is exporting more solar panels than ever, more parts for wind turbines going to Europe, United States, and other places, and that have to go through the Red Sea. So in a sense, all of a sudden I have the, if you want to call it, the old world of energy, which is the oil and gas going through the Red Sea, and all the other forms, the new ones, that whether you need it for solar or wind or EVs going through it. So the Red Sea became the hottest area in the world, regardless of the events of the Houthis or regardless what's happening in Gaza. Now, with the Houthis started attacking the ships that were supposedly owned by Israelis. A week later, they changed their story and they said they want to attack any ship going to Israel. And then the UK, the US decided to go to the Red Sea with additional navy to fight the Houthis. In my view, that does not make sense. The Houthis are a very small group, as people listen to that space we had about 10 days ago. The Houthis are a very small group. There is enough firepower for the United States and others in the area to deal with them. Their impact was limited. Now they've been bombing the hell out of them, and yet traffic continued to be rerouted, and we have less traffic in the Red Sea than before, which means that the bombing of the Houthis did not do much. And as a result, we have about probably 70 to 75% of traffic being stopped or diverted. No LNG passing through anymore, which will have an impact on Europe right now in the winter if this lasts for long. The other issue, that my main concern, is not what's happening with the Houthis or any fights that might happen in Yemen or in the Red Sea. My problem and my concern, and this should be everyone's concern, that the most important source of foreign exchange for Egypt is the Suez Canal. And now they lost most of it. The Egyptian economy is on the verge of collapse. Their currency is collapsing. In fact, just in the last few days, the pound went from, like, in the black market, from $1 to 50 pounds to about 70 right now, 65 to 70. Last year, it was only 15 to the dollar. So their currency is collapsing. The economy is suffering. and now they are losing the main source or the most important source of foreign exchange. So what's going to happen to their currency? What's going to happen to inflation? What's going to happen to political instability, to political stability, social stability in Egypt? I think we got to watch that. It's very, very important country to worry about. And I think if Egypt is going to be the victim of all of that, it's going to affect everyone in the world. Remember that in 2011, we've seen that during the Arab Spring, and we've seen the impact. Why we should worry? We were lucky in 2011, the events did not affect the Suez Canal. But now we have the following issues. And please, if someone is listening and does not know the map, just go to Google and pull Egypt's map to see what I'm talking about. Why or we are worried about the Suez Canal in a way that we were not worried about in 2011? Because if you look at the map of Egypt right now, they have a war in the south in Sudan. They have a war in the west in Libya. They have a war in the north, which is Israel and Gaza. The only place left basically is what they have on the Red Sea, and there is a war now. So the country is surrounded by wars, and inside we have a serious economic problem. We have a serious currency problem. And that's why we got to worry about the Suez Canal. About 5 to 6 million barrels a day passes through a Bab el-Mandeb, which is in the south next to between Yemen and Djibouti. More than that passes through the Suez Canal. Now, if someone's saying, well, you have the Red Sea, and why the Suez gets more oil than the south? Well, because the Saudis have pipelines in the middle of the desert from the eastern province all the way to the west to a city called Yanbu. It's in the middle of the Red Sea. So the Saudis can export oil and products from it without going through Bab el-Mandeb. And that goes through the Suez Canal. So there is more oil going through the Suez Canal than the south. So to whatever the case is, the main concern right now is really Egypt, is not Yemen and not anything else.
And what are the risks with Egypt? What could happen there? Do we need to worry about regime change? Do we need to worry about them shutting down the Suez Canal for some reason? What are the risks of something happening in Egypt?
Well, the risk basically is kind of multiple layers here. We start with the economic collapse because they wanted some loans from the IMF, and the IMF is putting some, as you know, they always put those stringent conditions, which include probably the liberation of the pound. And if that happens, then inflation is going to go through the roof, and they're going to end up with hyperinflation. How the public will react to that? This is the issue. What that leads to, we don't know. We can guess. But the issue that what's different now from 2011 regarding the Suez Canal is we have all those wars around that we did not have before. We had stability on all sides of Egypt. Now we have all those wars. And what that leads to, some crazy group or crazy individual just go do something, we don't know. But the issue here is the risk is way, way higher than 2011.
So we have a very significant stability risk with the nation of Egypt. Just about anything could happen there because of the economic pressure that this situation has created. Let's come back. We're so far just talking about the political premiums that are going on to the oil market because of these events that are happening. Let's come back to the base economic forecast. When we spoke to you last year, your outlook was that demand would continue to grow, although perhaps more slowly than some people thought. You said not to expect $100 prices in 2023. You nailed that call, needless to say. At that time, when we spoke to you last, I think you were still looking for $100 plus prices in 2024, but I believe you revised that lower subsequently in the year. So give us an update on where you stand now with respect to your economic forecast, and then how does that marry into the geopolitical premium that's on top of it?
So the story starts in December 2022 when the first time we shared the outlook with some clients, and then we posted on Substack in early January. And in that outlook, the one we talked about in the couple of MacroVoices, Basically, we said that we were kind of bearish in the first half, bullish the second half. The 2023 is a tale of two halves. It's still a tale of two halves, but we were really bullish on the fourth quarter, and everything went wrong in the fourth quarter. So just to give you an example, in the third quarter, according to the IEA, world oil demand increased by 3.7 million. Of course, that's mostly recovery from COVID, especially in China. And it dropped in the fourth quarter to 1.6. So you can see the massive drop in demand in the fourth quarter. So we were really wrong on the first quarter. That was unexpected. And if you go back and look at 2023, the 2023 has two characteristics. When we talk about 2022, before 2023, 2022 was a historic year by any standard, and we talked about it in the previous Macro Voices. It was a historic year, and I explained why it was a historic year. 2023 is not historic, but it has two characteristics. It is the year of records. We set so many records in the energy industry in 2023. Whether you are talking about production, you are talking about demand, you are talking about oil, gas, LNG, renewables, solar, wind, anything you can, we had records on almost everything. Several countries, basically, their production hit records. So it was the year of records. Also, what makes it different is it is the year where every single forecast failed. Now, in the previous years, we have some forecasts, basically, were correct. But 2023, every single forecast failed, including ours, because although our forecast for most of the year was like really spot on, and then we just lost it on the fourth quarter. So it was the year where forecast went wrong. And it was clear June, July 2023 that things are changing and things are slowing, and the growth in demand is way slower than what was expected. And our view was, if inventories build, then 2024 will change. But we did not know where we are going to go with the inventories. So we ended up with two situations. We had inventory build and a slower economic growth, which means that 2024 is going to be kind of a dull year, unlike what we expected 6 months earlier or a year earlier. So what we see today, with absent any political event that destroys capacity or lock down capacity, this prices Brent in the 70s and low 80s, probably this is going to be the most common throughout the year. The idea of 100, we've seen people talking about 130 and 113. There is no case for that. And even those who are using the Red Sea as a reason for $130 oil or 110, let's remember this. In September 2019, we had this major hit on Aramco. That was a big surprise because no one was expecting it. And we lost 5.5 million barrels a day. Yet, prices increased by only $20. So if the prices are 80 today, and we are not going to lose suddenly 5.5 like we did with Aramco, so why we have to go up by 50%? So it is very clear that, yes, with everything we have, things are not as rosy as some people expect in terms of prices. The rerouting of ships, of course, let's remember that everything we see today is inflationary. The shipping costs, shipping rates, especially for the spot, are going up. Insurance rates are going through the roof. The rerouting means we have more fuel consumption. Our estimates, based on what we've seen today, that oil demand might increase, or bunkering demand might increase by 200 to 350,000 barrels a day because of the rerouting. If we have a complete blockage of the Red Sea, that might go up to 700. So we have this extra increase or additional increase in demand that was not there just like 3-4 weeks ago. But at the same time, the cost is increasing. The cost is way higher. And at the same time, we have issues with LNG because now Qatar rerouted its LNG tankers. That means they will be delayed by about 10 days to 14 days in terms of arrival to Europe, if the weather is mild, Europeans are lucky. If the weather is really cold, then they have no choice but to import more from Russia. Remember that Europeans are still importing Russian gas via pipeline, and they import LNG. Right now, Europe's dependence on Russia is 17% of total gas imports. We expect that this rerouting might increase it to 20%. So it will increase Europe's dependence on Russia.
You mentioned that demand was starting to pick up now in the beginning of 2024. One of the things we've seen just in the last couple of weeks is that the prompt time spreads have moved back into backwardation, fairly significant backwardation. I know you watch that carefully. We've also seen, it looks like, the beginning of a breakout above the 55-day moving average on WTI. As we're recording on Tuesday afternoon, we're still trading at about 74.50, just half a dollar or so above the 50 or 55-day moving average level. It looks like maybe we're seeing the beginning of a new move to the upside. Do you think that's happening, or is this just noise?
It is very hard for me right now to see that. I think there is an impact. We have a political premium. I mean, that's very clear. But we have the impact of OPEC plus voluntary cuts. That's very clear too. But I want to mix between this one and the previous segment because I want to say something here that's important. Historically speaking, we have the VLCC tankers coming out of Saudi Arabia. They go to the Suez Canal. Before the Suez Canal, they stop on one of the lakes in a port called Ain al-Sukhna. There is a reason why they stop there, because those tankers are carrying 2.1 million barrels, and they cannot go through the Suez Canal because they are too heavy. So when they go to the Suez Canal, the ship becomes very wide, and that's not good. So what they do is there is a pipeline called Sumit Pipeline from Ain al-Sukhna, that's south of the Suez Canal. And there is a pipeline that goes northwest to a small town called Sidi Khair. It's a port on the Mediterranean. So those tankers empty some of what they carry into the pipeline, and they pump it up to Sidi Khair. Now the ship can float higher, and it can pass the Suez Canal, and then it goes left. Either it goes back to Sidi Khair and take the equivalent amount that it offloaded, or it can go on its own like this, and other small ships or small tankers can take the oil from Sidi Khair to other countries in Europe. That's why we always have VLCC, Saudi VLCC, or others from the Gulf in Ain al-Sukhna, always, because they empty there and then they go through the Suez Canal. As of yesterday, according to Kepler, zero. There is none. And inventories in Sidi Khair are declining. This is a very bullish signal if you want to focus on it. That's bullish because you don't have enough tankers coming like we've seen before, which means that either the Saudis are cutting like they promised, or there are more problems in the Red Sea, and that's why we don't see any tankers there. Aside from that, on the demand side, still the growth is not that strong. So we still have demand issues to deal with. Here I want to dispel a myth, and that's very common in the media and among some analysts, because this is a very important point to mention. People say that there was a surprise on the production side in 2023, and there is a surprise now in 2024, and therefore OPEC has to cut production, or OPEC plus. That's complete nonsense. Because if you go back to 2023, we got surprises on the upside, and we got surprises on the downside. For example, in the US, we got a surprise on the upside. But that needs explanation, because it's very important to understand that the upside in the United States mostly was liquids, NGLs, and biofuel. So we did miss big time on the biofuel. And the reason why, I'm not trying to defend myself here. I know nothing about agriculture. I am not an agricultural economist. I don't know anything about it. But biofuel added about like 400,000 barrels a day last year, which is a massive amount. So there is no way an oil analyst can figure this out easily and think, oh, I'm expecting, the biofuel to add 400,000, because it is added to demand. It is part of the liquids production. But if you look at what we produce from the fields and from the refineries, our number last year for US was 1.25, which was the highest number in the market, because we were very bullish on US production. Well, guess what? The actual number was 1.4. So even our number was more bullish than anyone else, yet production surprised on the upside, and it is about 150 above our number. But on the other side, there were surprises, big surprises on the downside. Norway did not deliver. Canada did not deliver. So when you look at the global average, there was no surprise on that. We did not see a surprise when we look at the global average. But on individual countries, yes. And therefore, OPEC already counted for all those increases on average, and there was no surprise there. The surprise was really on the demand side and the decline. And the reason why, because OPEC has the highest estimate of demand growth in 2023. They estimated demand to grow by 2.5 million barrels a day. And that wasn't the case. It was way lower. So it was a demand issue. As for 2024, it's exactly the same story. OPEC has some of the highest estimates of non-OPEC production. So they are already estimating all of that. There was no surprise. So it's not really a production issue. But to go back to 2023, one of the main issues that's still with us today from 2023 is this: that the growth in demand in 2023, although it was large, we got to realize that it is mostly recovery, not actual growth. At the same time, we have completely different worlds where we have most of the growth is in China, India, Latin America, and the rest of the world was suffering. It's negative, red. So we have unbalanced growth in demand in 2023. That's still with us today. But what the difference between 24 and 23 is that the recovery is over. We are done with recovery. So now we are going to normal circumstances. And normal circumstances, when we have two different worlds, part of it is growing and the other not growing, on average, you got stuck because the final number basically is a limited number. So we have an issue here. But what we are seeing in the numbers, and we just published two reports, one of them today on Substack and one last week, and I think they could be related to what you are talking about when you ask about that backwardation, because I think this is a point that need to be studied further. If you look at China's numbers for last year, we have a recovery in gasoline, we have a recovery in diesel. And when you look at the charts, you can see the dip during the lockdowns. So we have a major dip and then a recovery, and it is really a quick recovery. Here, we have to pay attention to the other details. The first one is this big quick recovery that happened does not happen when you have a recession or low economic growth, because the recovery from a recession or low economic growth takes time. This one, all you did basically just open the door and everything back to normal. So we have this quick recovery. But the lesson we learned is that when you have lockdowns, the essential things of life are still going. When you open the door and people get out, the demand for luxury items is going to increase. So most of the growth when it comes to energy was everything related to luxury, including jet fuel. Most of the growth in China was in jet fuel, 60% increase in demand of jet fuel. Why? Because it's a luxury item, you open the door, people started traveling. This is not going to be with us in 2024. It's gone. But again, if you go back to gasoline, diesel, and jet fuel, you can see the dip during the lockdowns, and then the recovery, some recovery in gasoline and diesel, But the jet fuel basically went through the roof simply because we are going out of lockdown. But there is something strange when you look at naphtha and LPG. It wasn't affected much by the lockdown, and the recent increases in them is massive. I mean, massive in a way that we never seen it in history. So what's going on? At the same time we are watching these numbers, Aramco goes to China and sign a massive multi-billion-dollar deal on petrochemical plants. What Aramco sees in China in petrochemicals that the rest of the world is not seeing? And why this massive growth in naphtha and LPG? Because of petrochemicals. So what happened until we see this massive growth? Well, our suspicion is that the only change we've seen in China is the massive increase in producing electric vehicles. What that means? In 2023, 9.5 million electric vehicles are sold in China. 9.5 million electric vehicles are sold in China in 2023. That's not related to anything. The production, of course, is higher, and they exported a lot to various countries. There's 9.5 million barrels a day. If you want to measure their impact, in terms of the reduction in gasoline consumption, assuming they replace gasoline, and assuming those electric vehicles did not replace previous electric vehicles, like the ones produced, let's say, in 2014 or 2017. In this case, they replaced 270,000 barrels a day of oil or gasoline. 270,000 barrels a day of gasoline. That's the replacement of 9.5. But this is only for fuel. But once you look at petrochemicals and you look at EV production, and you realize that those electric vehicles are using massive amount of products coming from the petrochemical industry to build the car. I'm not talking about the batteries. I'm talking about the body of the car and the seats and everything inside the car. And you look at the massive number that China produced at that time, it's coming from petrochemicals. Petrochemicals are coming from oil and gas. What that means? That means when we say 9.5 million vehicles replace 270,000 barrels a day of gasoline, this is only on the fuel. But when you look at the net, you need to count all the naphtha and LPG that went in. And based on those early numbers we are getting, it seems that to produce those EVs, we use 600,000 barrels a day. So if you look at the net, EVs led to increase in oil demand. And that's what we are going to see in the future if this trend continues.
I don't think that Just Stop Oil is going to join in and name you their third top favorite guy now, Anas. I think you've lost the title with them.
Well, I can tell you, if I get a drone flying above my house, I know they are here.
So it sounds like overall your view on prices for 2024 is basically maybe there's some bullish impulses in the system right now. Don't expect them to last all year. You're expecting oil prices to stay about where they are unless there's an escalation of one of the many geopolitical conflicts. And of course, there's plenty of risk of that. There always is. But absent that, you think 2024 prices stay about flat. Is that right?
Correct. And there are other issues here we should consider. At Brent at 80, everyone in OPEC and OPEC Plus is happy, by the way. I mean, 80 is good for everyone. Probably a little bit high for consumers. So the concern is, what would Biden do for the re-election? Will he withdraw oil from the SPR, for example, to lower gasoline prices, et cetera, et cetera? So that's another risk we have to look at. The related issue to this is kind of because OPEC is going to meet twice this year, OPEC Plus. We will see their actions. What we got to pay attention to is really this synergy between Saudi Arabia and Russia. This is a very important relationship to watch. The Russians do not want higher oil prices, period. Forget about the war. Forget about anything else. Putin realizes U.S. LNG basically is what's killing him in Europe. He realizes that whatever the U.S. is doing right now, because the share revolution enabled the Biden administration to do whatever it's doing, because we can export all that oil to the rest of the world. We can export LNG to the business of Europe on the U.S. is about 21% right now. It was zero just before the invasion. So he realizes that he lost because of the LNG. Now, where this LNG is coming from natural gas, and some of that natural gas, or most of it, is associated gas coming from shale, from oil plays. So when oil prices are high, those plays produce more gas. And because producers make most of their money from oil at $100 oil or 90 or whatever price you want to, they really don't care about the price of gas. And they can sell that gas. Of course, when I talk about gas here, I'm talking about natural gas, not gasoline. As you know, natural gas being sold at negative prices in many cases because producers did not care. They made their money on oil. And those wells in West Texas, they bring massive amount of natural gas. So Putin realizes that he should keep prices low so he can curb U.S. gas production. As long as he can curb U.S. gas production, then all those new LNG plants are not going to be built because there is no reason for them. So this dynamic between Saudi Arabia and Russia, the Saudis want prices above 90. Putin want them around 65. So the question, I'm just making this up. I have no support for this point. But is the average they agree on is something between like 75 and 85 and they don't have to fight over it? We'll see.
I want to move on now and talk about the longer-term outlook. We recently had the CEO of Chevron commenting that 2025 would be the year where we'd start to see a shortfall of global oil supply compared to demand. There's a chart that JP Morgan has that shows around 2025, 26 in there somewhere that supply and demand start to diverge, basically because ESG has finally caught up with the market, that we had a number of years of lesser investment in the market, and people have anticipated that by the end of the 2020s, there would be a massive deficit, insufficient amounts of oil to meet demand. What is your view of those views? Is this idea that we're headed toward a late 2020s oil and gas energy crisis real? If not, why not?
Yes, I think if you recall, you and I talked about it in the last episode. In a sense, we talked about it before those guys talk about it. We talked about that future energy crisis. And I think they are correct for the following reason. If you look at the major increases in production in Guyana, in Brazil, in Norway, in Kazakhstan, the investment decision was made like between 2014 and 2017. So the impact of COVID on investment, not on production, the impact of COVID on investment have not caught with us yet. That's going to appear in 25 and 26. That's aside from the normal decline because of the ESG and all the other stuff. But at the same time, I would like to emphasize the point that we have a major failure of green policies around the world. And because of this failure, demand for oil and gas and coal is going to be way higher than expected. So on one side, investment impact is going to appear, and we are not going to have enough supply. On the other side, we have surprises on the demand side. And here I would like to mention a very important point related to green policies. If you look at ISO grid, that's the New England grid. As you all know, New England is mostly Democrats, mostly on the left. They support, the fight against climate change. They are pro-environment, all kind of things. And knowing what you know about them, you think if you go to look at their grid, that they are super green. Well, look what we had last week during the cold wave. Last week, we have a day when wind contributed only 1.5% of power generation. 1.5%. And fuel oil, contributed 6%. They came back to oil. So that's when you talk about the failure of green policies. The impact was oil demand increased. Last year, when they had a freeze, in certain days, oil contributed 40% to generation. Why? Because the LNG prices, as you recall, was super high, and they couldn't import because they have to import it because we cannot supply them with gas. There are no gas pipelines basically to that area, so they have to import LNG. LNG was $70 at that time, so they decided to switch back to oil. But this story of switching back, look at Germany. Germany switched back to coal, and just yesterday they decided to build more natural gas plants, power plants. They refused to sign, just 6 months ago, they refused to sign a contract with Qatar, long-term contract, because they said gas is a fossil fuel, and we don't want to commit to it for long term. Now they are coming back. They are committing for long term. So this retreat is not counted for in the long-term outlooks, and it's going to hit us suddenly while investment basically is low. So yes, I am with them. I think we are going to have energy crisis.
But it sounds like you're not concerned about 2024 being the year that energy crisis starts. It sounds like you think we can get through it.
I think 2024 is going to be a very mild year.
So is 2025 the crisis year, or is it farther out, later in the 2020s?
No, it cannot be the crisis year because we still have about 4 million barrels in spare capacity in the oil-producing countries, so that will be used first. So one measure basically to figure out whether we are heading for a crisis or not is to look at the decline in spare capacity within OPEC, especially in Saudi Arabia. And that's one indicator.
So the serious shortfall of where the point where supply just can't keep up with demand is late 2020s, 26, 7, 8 in there somewhere.
Yes. So 24 is mild. 25, where probably we'll use some of that spare capacity and then start showing up later.
And is spare capacity the best thing to monitor? Is that what we want to watch for when we run out of spare capacity? That's when we know that the shit hits the fan?
This is another important point here. We will not run out of spare capacity for a reason, because there is some spare capacity that is counted as spare capacity, but it's not marketable. What that means is some countries are, for example, counting heavy crude as capacity, but no one wants it. People wanted the lighter crudes. So it just like we want to see a decline, although organizations like OPEC or the IEA or others still showing, let's say, 2 million barrels of spare capacity. But what is the true spare capacity in this case? Because there is some oil that is literally not marketable. If you go back to 2008, there was a meeting in Jeddah because prices, as you know, exceeded 140 at that time. So there was a meeting in Jeddah, and the former Saudi oil minister, Noaimi, offered the market. He said, I have 2 million barrels if anyone wants to come and buy them. Well, the market was not interested. And the reason why the market was not interested is because it was heavy crude. And who is going to buy heavy crude at above 100? No one. So they couldn't even sell it. But we still show 2 million barrels of spare capacity. So in a sense, we have to look at something we call marketable capacity instead of the spare capacity in total.
It sounds like your estimate is right now the world has about 4 million barrels of spare capacity. That's not that much. I mean, if we had one significant geopolitical upset, you could easily take 4 million barrels of production offline. So it sounds like that we are vulnerable to a price dislocation if there is a major geopolitical event. Barring that, sounds like we kind of stay where we are, 24 and 25, and late 2020s is when we get into the real crunch.
Yes, but I would like to add that once prices go up, and let's say 120, 130, you are going to get a reaction from demand too. So probably you can get a reduction in demand by 1 to 2 million barrels immediately on those prices. So it's not only one-sided, it's two-sided.
Well, Anas, I can't thank you enough for a terrific interview. Let's try to tie all of this together. Give me the overall summary of the outlook for the market based on everything we've discussed.
Well, when we look at 2024, it's still the story of two worlds where we are going to see growth in some quarters and negative growth in others. So that's one. And the other issue is let's focus on this China petrochemical thing, because if what I said is going to be a trend, this is a major, major issue where the petrochemical demand for oil is going to outstrip what EVs or electric vehicles can replace in terms of gasoline and diesel. But that's going to be a really big story.
You know, this is something I've often wondered about. Has anybody ever done a study and said, look, just set all of this climate fanaticism about how we're going to completely eliminate fossil fuels forever? Just set that aside. Let the grown-ups into the room for a minute and say, okay, look, we know that we're going to need fossil fuels. We're going to need petroleum to make asphalt to pave roads with and petrochemicals to make plastics with. So there's got to be some minimum amount of petroleum that the world is going to have to continue to consume in order to have asphalt for roads, and that's not an easy thing to replace, by the way, and petrochemicals to make plastics, which is absolutely essential. Has anybody done the analysis to say, okay, if you're going to need that much petroleum in order to get whatever the global demand is for asphalt, well, if you're going to have to refine enough petroleum to meet the world's plastic and asphalt needs, how much fuel oil, how much middle distillates do you end up having to produce, having to refine in order to get to just the minimum that the world needs on asphalt? Has anybody ever figured that out and told the climate guys about it?
I haven't done this, but I have a kind of a percentage in my head. If everything goes well for electric vehicles and they are able seriously to reduce oil demand significantly, the minimum we need from the current production, we are producing about 100 our demand is about 103 of liquids. We need about 80% of that. So we can get rid of 20% or 23%, something like this. But below that, we cannot go because of all the other issues. But again, this is, I'm not talking about an academic study here.
Well, Anas, I can't thank you enough for a terrific interview. Before I let you go, though, please tell our listeners a little bit more about what you do at Energy Outlook Advisors. You're also a very well-respected keynote speaker. I know your schedule's filled up quite a bit recently with having been named the third most influential speaker and commentator on energy markets. Please tell people where they can find your Substack blog and how they can get in touch with you if they're interested in having you speak at their event.
They can Google my name, Anas Alhajji, or go to my Twitter account, Anas Alhajji, Anas Alhajji, which is my name. And they can get all the information there. They are in the bio. For those who are interested in speaking engagement, they can reach me through their website or through Twitter. And for the Substack, we do have two types of Substack. We have the daily energy report, which is issued daily. And then we have the newsletter. The newsletter basically is more in-depth and intended mostly for companies and financial institutions and others.
Patrick Seresnik, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Seresna.
Eric, great interview with Anas. Now joining us again in the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Anas's picture saying, looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
It was a massive drawdown week, with crude oil printing a drawdown of 9.2 million barrels, Cushing, Oklahoma drawing down 2.0 million barrels. The builds were on finished products, gasoline building 4.9 million barrels. Distillates, though, still drawing down 1.4 million barrels. All of those things netted together is a net drawdown on petroleum products of 5.7 million barrels on the week. U.S. production was down a full million barrels a day to 12.3 million, not 13.3, but 12.3 million barrels. That sounds like a crazy data error or something. It's actually real. It's the weather. It really is too cold to pump crude oil in North Dakota this week, and there's a lot of production that's been shut in because of the extreme weather there. So that's the reason for the depressed U.S. production figure, which is actually a real number. Obviously, that weather anomaly is temporary. The question is, how temporary or untemporary is the recovery? Do we bang right back up to 13.3 million barrels next week as that production comes back online? Or is it going to take several months to crawl our way back up to 13.3 million barrels? That'll be the next thing to watch. Time spreads are looking very strong, especially at the front of the curve. The prompt spread, the very first month, has flipped decisively back into backwardation, which is a signal that the market is tightening, and it's oftentimes a prediction that flat prices will be moving higher in coming days and weeks. So let's keep an eye on this market for it maybe to move higher. We're starting to see that strength. We're also nicely above the 50-day moving average, and we're just coming up on the 200-day moving average. It's 75.42 on the contract chart. If we can get above that, it's another important technical analysis hurdle to get above. Much of the strength that we're seeing, though, is coming from weather disruptions and other events that are not really long-term. Certainly, the Red Sea situation has added a lot of political risk premium to this, but these things will eventually pass. So I don't think there's anything that's really in the system to take us to $100 crude oil prices. But again, the geopolitical situation is very much in a state of flux. Anything could happen there. And if we had a major escalation, it could change things quite dramatically.
Eric, while Anas had a great analysis of oil that it more or less is going to be far more range-bound and contained in its trend this year, I still think that there's plenty of potential for us to go back to last year's highs and then bounce around in that trade range. So we could still have a breakout here that sees even a $10 advance in crude oil before it probably comes right back into the range. The key here is that the pattern of lower highs and lower lows that was so dominant since September has really stalled. And the price action has been very distinct, which is that almost every single time we had one of these 1 or 2 day sell-offs of $2-3, it was immediately accumulated and brought to the top of the range, and we're now trading above the 50-day moving average. We're seeing a basing formation that leaves lots of room for at least an oil advance into the mid-80s, and so we'll be looking here whether or not this continuation pattern continues. All right, let's move on to the equities. I want to get Nick involved in this conversation. Now, Nick, the S&P 500, a big explosive rally in this post-OPEX cycle here. We're near the 4,900 level. What are you watching?
Yeah, Patrick. So spot price right now in SPX is approximately 48.65. We have a call wall above at 4,900 and a put wall below at 4,800, which was previously the all-time high. The implied move for the February 16th monthly OPEX is plus minus 110 points. Therefore, the upper implied move is 49.75, just shy of that key 5,000 level, which everyone's talking about. And the lower implied move is 47.55. Key resistance above is at 4,900 and key support below is at 4,800. Now, as I mentioned last week, I thought we'd hit all-time highs, which we did. We pushed past them well beyond and pushed toward 4,900. I do see a pause in the markets here, followed by a decline into the February OPEX. But again, that's contingent upon two things. One is FOMC next week. And the second thing is earnings season, which has thus far kicked off with Tesla missing earnings so far, as well as Netflix beating earnings. What are your thoughts here?
Well, Nick, for me, the breadth of the market continues to deteriorate. When you look at the Russell, the way it gave back the initial gains, the way the equal weight S&P 500 index didn't make higher highs, this is a market that is relying more and more on the leadership stocks, the Mag 7s, to keep this trend going. Otherwise, we would need some sort of key sector rotation and a new leadership emerging. So this is why those earnings on a lot of these Mag 7s next week may actually decide a lot of this. Now, I think that it is would be incredibly normal for the market to at least print on a very short-term basis above 5,000 to give the media headline print of a big hurdle being beaten. But we're all seeing some of the momentum from earlier in the week now dissipating. So it's one of these areas where I don't see much upside, but no immediate reason for the market to reverse until we get to that key news next week. Like you were highlighting, the FOMC is on Wednesday, jobs numbers on Friday. We got earnings like on Apple and other ones like that late next week. And so really, I think that the big moves in the market are really going to be in February, going into that OPEX you just talked about in the interim between this period and next week. It wouldn't shock me if we tried to crawl up towards 5,000, but the momentum of the market is clearly going to keep a lid on this. Nonetheless, let's move on to the Qs. And what level are you watching on the Nasdaq?
Yeah, so right now in the Qs, spot price is approximately 427. We have a call wall above at 430 and a put wall below at 420. The implied move for the February 16th monthly OPEX is plus minus 14 points. I do expect that to be greater because of the tech earnings coming out the next few weeks, as well as FOMC. However, the upper implied move is 441 and the lower implied move is 413. We have key resistance above at 430, which are also the all-time highs, and key support below at 410, which are the previous all-time highs. As I said in previous weeks, I've been wrong for a while now. Tech is not where I'd place my bets. As you said, the breadth is weakening. I'm seeing too much money flowing into these large names, and I do think at some point it's going to turn around in a violent fashion. I'm more inclined to look at the small caps because, again, if we do push to that 5,000 level, I think we need to see an increase in breadth in order for that to happen.
It really is going to be decided by those earnings. Everything from Amazon to Google to Apple, Microsoft, everything is up to bat next week. And now there's always the chance that these are going to be beats and that that may actually be what drives another 100 S&P points higher as the Nasdaq leads the way for one more impulse. But really at this stage, it is going to simply be a storyline as to whether or not these Mag 7s have overshot or not. I mean, the semiconductors have been doing very well, and a number of these plays have just been where all that money flow continues to happen. And so right now, that resistance here, at least for the remainder of this week, is likely at the highs of yesterday. But I think that we're going to have some big movements starting next week. Nonetheless, let's move on to the volatility index, which has had numerous quick little pops, but we're back to the 12 handle. Volatility is definitely on the bottom end of its range, and no sign of fear coming from this index anyway. What levels are you looking at?
Yeah, so with the VIX at around 13, that denotes about 0.75% movements intraday, top to bottom. What I'm looking at is that I'm seeing a lot of these covered call and buy right ETFs selling premium on the call side and the put side. So this is what's been suppressing volatility, even though we've had expansions of ranges beyond what's expected. I do think it'll present a problem at some point in time, but when that is anyone's guess. Right now, I'm just being cautious in terms of what I'm doing with regard to premium selling. I'm waiting for ranges to expand and then selling premium on the upside or the downside, depending on where we move. But again, tracking those intraday ranges is very, very key on SPX in particular, because the VIX is predicated upon that. And I think we see perhaps a pop in volatility following FOMC and into earnings season as well. Now, moving on to page 7, we have the US dollar index, which has recently bounced off lows. What are your thoughts here?
The dollar's holding its own at 103 on the Dixie. It started to roll over on Tuesday night into Wednesday, but then as the PMIs unexpectedly beat expectations on Wednesday morning at 8:30, that kind of jolted the dollar back up over 103 as rate cut expectations for March were crushed by the PMI data. Now, I think if you take a step back and look at that PMI data, is it really telling us that there's a systemic change, that inflation is back? Or is it just telling us that this Red Sea disruption and screwed up supply chains around the world, and maybe it's just a temporary friction that we're seeing on those PMIs? Not sure what it is. We'll have to keep an eye on the data, but the question of whether or not inflation risks are really behind us is very much reinvigorated by that PMI print.
I find it fascinating that we're at this level here, Eric, because when you put in context the sell-off that we've seen through the months of November and December, we had a 2-month sell-off that saw the Dixie go from 107 down to below 101. And now we've pretty much 50% retraced that sell-off. And we find ourselves right at this pivot with us recording this right before the ECB press conference and the FOMC next week. And it'll be really interesting to see whether these central banks really get a new currency trend underway. Right now, if the dollar index can't beat this 104 to 104.5 level on the upside, it is very common for retesting of lows or establishing a basing formation before any advance. So assuming that this doesn't have a big move on the ECB, I wouldn't be shocked if we had temporary stabs down toward 102 on the dollar index. But in general, the dollar, I think, is establishing a low from which it may potentially rally later in the first quarter of the year. Right now, though, it's going to be all about these central banks.
Now, moving on page 8, we have the gold futures chart. What are your thoughts here?
The gold chart was actually looking pretty strong with the February 2024 contract at almost $2,040 before the U.S. PMIs unexpectedly beat expectations at 8:30 on Wednesday morning. That caused rate cut expectations for March to collapse, and that caused crude oil to collapse $25 lower in almost as many minutes. We're getting closer and closer to that 1985 level. Below that level, you'd have to say that we have a new pattern of lower swing lows on the gold chart. We haven't gotten that yet, but we would be seeing a pattern of lower lows if we got to 1985 or lower. I'm still hopeful that we're going to hold above 2,000. We'll get about a $20 boost, or the illusion of a boost, from the contract roll when we roll from the February to the April contract. The contango in the market will cause the continuation chart to show as if there was an overnight increase of $20 in the spot price, although that's not really what's going on there. It usually has the effect of helping sentiment in terms of giving people the impression, I looked at it a couple days ago, it's $20 higher now than it was then. Actually, the price didn't change. It was just the contract roll. But that usually fakes everybody out, and it helps to build bullish sentiment even when it shouldn't. At least I hope that's what's going to happen. If we get an actual sustained move on the continuation chart below 1983, that's the 100-day moving average, you really have to start to wonder what comes next after that. In this ascending triangle pattern that we're in, you can get back down to 1900 before you violate that lower trend line. So I think there will be a move to higher gold prices before year end for sure, but markets love to shake out the weak hands before they deliver that ultimate move higher, and a washout down to the 100-day moving average at 1983 or even a move below that is not all that difficult to imagine from here.
Well, when I'm looking at this gold chart, we're still a stone throw away from all-time high, and it is a very, very bullish chart. We are clearly, though, have started a consolidation of some sort. The bigger question, is this a short-term consolidation the way we saw in February going into early March at the start of last year that explosively started another key leg higher? Or is it going to be a prolonged trade range that we saw in the summer of last year? One way or another, I think that it will resolve itself bullishly on gold, but it's really going to be about how, kind of sizing up where and how long the sideways consolidation plays out before the setup for the big gold breakout.
Now on page 9 here, we have the uranium chart, which Eric's been discussing for a couple of weeks now. It's been on a pretty crazy run. Eric, what are your thoughts here?
As I mentioned last week, the big breakout above $100 on the spot uranium chart left a lot of gaps on various uranium mining charts, and I've been buying those gap fills all week. The slow stochastics on several of those charts suggest that this correction may still have farther to go to the downside, even beyond those gap fills, but I definitely see this as a buy-the-dip opportunity in uranium miners. Maybe we still have a little bit more to go before the correction is over, but one way or another, buy the dip.
Yeah, well, for me, Eric, the U308 contract, I want to see it stay above the 100 level on a sustained basis. I mean, a short-term break below 100 and then pop back above can always happen on a short-term basis just on liquidity. But I generally want to see whether or not the bulls are buying all dips. On the U.UN, the Sprott Physical Uranium ETF, that would be around the $30 level. And so we're going to see whether the bulls defend this and start accumulating dips here. Generally, the bull trend is quite intact. The profit taking in a bull run happens all the time. The biggest question, of course, is simply, will the dip be bought? And I think we're going to slowly be approaching here levels that should be accumulated if that trend remains intact. Finally, though, Nick, I want to just touch on page 10 where I have the 2-year T-note futures. I just thought this was interesting because we're going to have the FOMC announcement and press conference before we record another episode. And obviously the 2-year note and the 2-year yield are quite sensitive to the path from which people anticipate the Fed funds rate to go. And clearly we went from a March meeting chances of a rate cut being well over 50% to now only a 44% chance, which is basically now the rate cuts are now being pushed to the May meeting. And if we continue to see half decently strong economic data, big question in my mind is, does that cause the Fed to continue to stay in their pause mode for longer, and the market is simply getting too excited about a new rate cut cycle too early. And right now, watching the FOMC and whether or not the 2-year bond actually breaks out on that with some sort of a dovish tone, or whether or not Powell just continues to kind of talk the game of wait and see. It's going to be interesting to see how it plays out.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview and the chart book we just discussed here in the postgame, including a number of links to articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K. And follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.